Okay. Good morning, everybody. Let's start. It's a full house. Welcome here at this webinar about CBAM hedging, or as we said, CBAM costs are rising. Hedge now or fall behind. My name is Marcel Duits. I'm the Chief CBAM Officer of Dubrink, and I'm here together with Jan Joost, CTO of Dubrink. However, as you might see, today we are not with Dan Malevsky. Dan is well known in the CBAM community. We met him actually last week. It's a very tall guy, and there are two ways how you can get him on his back in his bed. One is if he's tired, and the second is if he is sick. And today, unfortunately, Dan is very sick. However, if we would speak in football terms, if Johan Cruyff is not able to make it, that's very sad. However, if then Maradona shows up and takes over, the crowd is still happy, and that's why I actually can introduce to you Louis Redshaw from Redshaw Advisors. We're very happy that you were able to take over the presentation of Dan Malevsky. And I would like now to give over the intro to Jan Joost, who will talk you through the housekeeping rules of today. Enjoy.
Well, quickly about us and also about this briefing, I guess. My name is Jan Joost Brinker, CTO at Dubrink. I deal with all of the technical and consultancy parts of our business. And today, I wanted to talk to you about really the different, essentially, levels that exist within CBAM. The first of that being the understanding of CBAM. And the understanding of CBAM can really happen, first of all, by self-study and webinars such as these. And another way, of course, is through the CBAM 3004 CBAM fundamentals trajectory. You can use that to essentially learn more and more about CBAM. Yesterday, we trained the trainers. So yesterday, a couple companies came to our offices to learn more about CBAM and to learn more about CBAM as well. Then the next logical step in the journey when you're dealing with CBAM is the simplification of CBAM. And that really exists in two ways as well. It can either be a matter of automation, which is something that we provide with our platform, or potentially outsourcing it in case you literally don't want to deal with it at all. And those are both services that we can potentially help you with. Then we get into the forecasting of CBAM, and that's really about both costs as well as the emissions, because both of them are necessary in order to really figure out, to have a clear picture, essentially, about what your costs are going to be. Then the next two topics on the list are obviously the hedging of CBAM, which is the topic of today's conversation, and potentially down the line, minimizing CBAM through decarbonization of your supply chain. Today's topic is obviously on the hedging of CBAM. If you wanted to know a little bit more about the first three steps of this ladder, we are a CBAM company. We have a best-in-class CBAM platform. We also provide consultancy and a little bit of education to help you get started and really help you ascend that ladder. Our platform works in 27 languages. We did not have Greek language support, but yesterday somebody asked us about that. So in the next week or so, it will be 28 languages. We try to turn CBAM into a strategic edge, helping you navigate that. And well, we're just a phone call or an email away to really get you started and help you solve any specific CBAM questions that you may have. Now, the way it works, you load your data into our platform. You simply connect your supply chain to our platform. It's free for them, and they send back the data. They fill it out intuitively in their own language, because 27 languages, right? And basically, we validate some of the data that we receive, and then we send it back, and you can simply do a one-click declaration, get analytics straight into the platform, which you can then, of course, use in your conversations potentially with a hedging partner. That being said, I'd love to hand over the mic to Louis, who will give you a little talk about CBAM hedging itself.
Very good. Thank you for the warm introduction, Marcel and Jan Joost. My name is Louis Redshaw, and I put the Redshaw into Redshaw Advisors. And again, sorry that Dan can't make the call today, but hopefully the slides I'm about to present will do a good job of covering for Dan today. I'm just going to work out how to add my slides to the screen. So bear with me a moment. I think we're there. And here they come. Great. And so, very much on the theme of hedge now or fall behind, and I think that will all become clear over the course of this presentation. I'm going to go into some fairly basic detail about the EU ETS. I'll also talk a little bit about CBAM just to be absolutely certain everyone's on the same page. Then we'll move towards what the future looks like and why hedging becomes all important. Now, I've got a lot of slides, so I'm going to go through them fairly quickly if I can. The objective being to leave plenty of time for questions at the end. If people have queries, then of course ask in the questions, but also we can, I expect we can follow up anything that people didn't fully understand later on after the webinar. So moving swiftly on, what we're going to talk about today, I'm going to do a CBAM overview. We're going to then take a look at the EU emissions trading scheme basics. Then we'll look at CBAM costs, CBAM certificate costs, and then how to manage them. And then we'll follow that up, of course, with a Q&A. So getting started, let's talk about the basics of CBAM. And the bottom line here is that CBAM, the carbon border adjustment mechanism, is designed to prevent carbon leakage. What is carbon leakage? In essence, it's the offshoring of carbon emissions by importing carbon-intensive goods. And back in 2005, the EU emissions trading scheme was born, and it's the first geographic carbon pricing system, and it causes carbon leakage to be a real thing. Now, in 2025, 20 years later, the cost of emitting a ton of CO2 is around 70 euros. Actually, right now it's 76 euros. It can be pretty volatile, and I'll talk about that a little bit more later on. Now, what's significant here is the price of carbon in the EU emissions trading scheme is expected to increase and to continue to increase. And I'll put a very basic premise to you to demonstrate why that is expected to be the case by anyone that has close involvement with the EU ETS. But getting back to EU industry and the EU ETS, if you put a price on carbon, then EU industry has an additional cost that falls entirely upon it. And as you can see in my set of scales here, imports with no carbon cost have an advantage. So EU industry is at an automatic disadvantage when the EU ETS came about. But there are two ways to balance that disadvantage. The first is free allocation. So the cost comes out of the scales for EU industry and levelizes the playing field with imports by giving a free allocation, which means that those EU industry companies under the EU ETS don't have to buy EU allowances. The other way, of course, is to put the cost on imports equal to the cost on EU industry. What can happen, of course, is that other countries already have a cost of carbon, in which case, under the CBAM, the cost of carbon paid in another country is deducted from the cost of carbon that's expected to be paid at the border with the EU. Now, what free allocation does in the case of the EU ETS is it takes away the price signal, the carbon price signal from companies, and doesn't cause them to be as incentivized as they can be to reduce carbon emissions. And so the way CBAM is envisaged is there's a transition from a free allocation model that exists today to a CBAM model whereby both domestic and international producers of covered goods get the same cost of carbon. And we'll go into that a little bit as well shortly. How does this all happen? Well, I've got a simple diagram here. I've got a non-EU supplier on the left, I've got an EU supplier on the right, and I've got a buyer, the importer, in the middle. The EU supplier is subject to the EU emissions trading scheme, of course. The non-EU supplier with no cost of carbon. So we put CBAM at the border. So where the imports come in, the cost is levied, and that should equalize the cost between the two. The scope and coverage, you're all pretty familiar, I'm sure, but just to go through to make sure everyone is on the same page: cement, electricity, fertilizers, iron and steel, aluminium and hydrogen, all are covered goods under the current CBAM proposals, with some exclusions now. So low weight consignments, personal goods, some military goods, and anything subject to the EU ETS already. And then to comply with CBAM, companies must, or importers must, measure the embedded emissions of their goods, report those emissions via the CBAM registry. Got to get the emissions data verified, and then importers must procure CBAM certificates. I say from 2027 because that's when CBAM certificates are first available, but the obligation starts from 2026. Now, if you don't do that, it gets costly. So there's a penalty under the EU ETS for companies that don't comply with it, and those penalties are replicated here for CBAM exposed companies, for importers. It's 100 euros per ton plus an additional penalty if you're not registered and authorized as a CBAM declarant. Now, the way that that we talked about earlier, that there's a transition from 2026 to 2034, is that CBAM phases in. You should all be familiar with this curve by now, I think. We can see CBAM started in 2025, but actually it started with a 0% requirement on CBAM, rising to 2.5% in 2026, 5% in 2027, and so on, all the way up to 100%. Now, as importers are increasingly exposed, EU ETS participants are increasingly have their free allocation taken away. So the opposite happens to companies in the EU ETS. The amount of free allocation they get in 2025 is 100%, and in 2034 it's 0. So when we get to 2034, both EU industry and imported products will all see a 100% cost of carbon on their goods, in order that there's a level playing field for competition. The cleanest will sell the most goods. Just a brief timeline on anything left over in the CBAM that we haven't got announced already, and there's we've got some consultations going on in Q4 this year. The definitive period starts on the 1st of January. We've got a few things on this chart. I'm not going to go through it in any particular detail, but there are some key dates that people need to be aware of, and it's worth taking a note of those. If we have a little think about what we know and what we don't know about CBAM, we've had the omnibus package launched in June, and what that does is simplifies the CBAM, which is very welcome. I'm sure you'll all appreciate if 90% of the importers are now exempt, that reduces the administrative burden considerably. We also hear the news that you can't buy CBAM certificates in 2026 despite having an obligation, but the surrender deadline delayed till 2027 is pretty helpful. Then we got some affirmation that CBAM will enter into force from 2026. Some rumours out there that it might be delayed, but that affirmation confirms that it will start from the 1st of January. And then what we're waiting to hear about still, we've got ongoing consultation on extending CBAM to additional goods, how to tighten the ways around the system people are trying to find, and some clearer rules on electricity imports. On the benchmark side of things, the thing that everyone is waiting, well, currently patiently, presumably starting to become impatient, everyone's waiting for those benchmarks, which we might get in Q4 2025. Let's hope we get those. Otherwise, it starts to become very difficult for people to understand their risk exposure. It's worth pointing out some rumours of some changes to CBAM. We could perhaps cover those in the Q&A. We're aware of those rumours, but we're awaiting some facts to support those rumours. But certainly there are efforts to simplify further CBAM, which will have some positives and some negatives. Now, I think we all know that CBAM certificates are linked to the price of EU allowances, but what are EU allowances? Indeed, what is cap and trade? So just so that we don't confuse carbon markets with anything else, I'm just going to give you a really quick 101 on the EU emissions trading scheme. And if you take a step back and you think about how one can limit carbon emissions from industry, from an economy, there's 4 ways to do that. And the first is direct regulation, telling people what they can and can't do. Then there's cap and trade, which I'll talk about in a moment. We have voluntary carbon offsetting going on. And of course, you can have a carbon tax. Those last 3 all are putting a price on carbon. So that's step 1 of creating a market. But in reality, a tax is quite a blunt instrument. So carbon markets consist of cap and trade markets and voluntary offsetting markets. Now, how to think about how those 2 markets work, you've got to think about the motivations of the people involved in those markets. Now, you either want to do something about your carbon footprint, or you need to do it because you're obliged by some form of legislation. And then on the want side of the equation, we have the voluntary carbon markets. Best example I can think of for a big company that's voluntarily offsetting its carbon footprint is Microsoft. They set out to offset all the emissions that they have ever produced in the life of their company. A very noble aim. It's something that they want to do. And the risk in the voluntary carbon market is very much reputational. Companies managing their reputation when it comes to climate stewardship. And arguably, a lot of companies are managing that risk voluntarily because there are no rules, no legislation to tell them they must do it. So a whole industry has sprung up. But voluntary carbon markets must not be confused with compliance carbon markets, such as those that, in emissions trading schemes. Now, the EU emissions trading scheme is an example, and all large industrials in Europe are covered. Now airlines, ship operators, and from next year, importers. Now, the primary risk in an emissions trading scheme is financial. If you don't meet the rules of the game, then you will get a fine, you'll get a penalty. And it's also fair to say that the financial risk also creeps into the price of carbon that you pay. As we'll describe shortly, the price of carbon can be very volatile and can be very high. Now, what's cap and trade? Simply put, if one company can reduce its emissions at a lower cost than another, it makes sense for that company to reduce its emissions and for the other company to buy those emissions from them. The way this has to happen, you need to have the rules and regulations in place. You need to put a cap on the total emissions. Then companies must surrender allowances each year. You need to have a robust monitoring, reporting, and verification regime. And as we've already explored, free allocations can be used to subsidize companies that are at risk of carbon leakage. And CBAM, of course, is all about preventing or stopping free allocation to European industry, and then therefore leveling the playing field. The currency of the EU emissions trading scheme is the EU allowance, EUA for short, and EU allowances are homogeneous. Every EUA allows the emitting of 1 ton of CO2. They are distributed to market participants either by auctioning or free allocation. And EU allowance auctions take place nearly every single day, every single weekday. EU allowances can be stored, they can be transferred, and they don't expire. Storage cost is essentially zero. Transfer cost is essentially zero, and they last forever. You can roll them into, we're currently in phase 4 of the EU ETS. You can roll phase 4 EU allowances into phase 5 without limitation. And finally, EU allowances trade in very liquid markets. They also trade, so they trade on exchange, but they also trade over the counter through brokers. And you know, the EU allowance market is vibrant. It's liquid. Bid-offer spread is narrow. The traded volumes are huge. You know, with tens of millions of tons trade every single day. And here we can see a little bit of price history, which starts to demonstrate the volatility that you can expect in the EU emissions trading scheme. Starting on the left-hand side, we've got very low price. I mean, the price hung around in single figures for many years, and that was caused by oversupply issues. There's a whole detailed explanation for why those prices were so low, but the EU didn't want the prices to be low because they weren't sending a very powerful price signal to prevent pollution. So they introduced a number of measures to soak up the spare EU allowances. So we have this MSR, which is called a market stability reserve. Even though the market stability reserve made a really big dent in the oversupply in the system, we had several years of record low gas prices, which dampened down EU allowance prices at around 25 euros. But as we all know, gas prices went completely crazy, and with gas prices going up, EU allowances went up. Now, that's quite a significant point, actually. Why would EU allowance price go up if gas price went up? The answer is that one of the easiest ways to reduce emissions in the whole of Europe is to burn less coal and burn more gas in its place in power stations. So typically, a coal-fired power station produces twice as much CO2 as a gas-fired power station. If gas price rises, there's more demand from coal-fired power stations for EU allowances, and that will cause the price to rise. And so that's what happened. And we've got a few other political interventions along the way, and some fundamentals involving gas and coal. And we see some pretty serious volatility. Price topped out at about 102 euros, and currently, as I mentioned before, about 76 euros. Now, CBAM costs. Let's have a think about what the exposure of an importer could be. I've got an example here, some hot rolled steel imported into Europe in the volume of 100,000 tons per year from Turkey. So Turkey's got no carbon price at the moment, and the example here is 2026. And in this equation, we've got a number of factors, and rather than go through them one by one, I'm going to put some examples up. If we look at the embedded emissions of those goods, an example is the 2.14 tons of CO2 per ton of good. If we look at the EU benchmark, not the official one, but our estimate, we say that's 1.97 tons. That means the import is more carbon intensive than the domestic production. Apply the CBAM factor, and then next we're subtracting. It's not a. It looks like a complicated equation, but it's not really. Here we've got the number of factors: the price, expected price in 2026 on the right, the embedded emissions of the goods, and then we've got the carbon price paid. So we know it's 0 euros per ton of CO2 in Turkey. So this brown part of the equation adds to nothing. And what we get at the end, when we multiply by the number of tons of goods being imported, is the number of CBAM certificates required by this importer in 2026. Clearly that would change in 2027 when the CBAM factor decreases, or the share, the inclusion of imports emissions increases. But we've got 21,000 carbon credits needed. So if we just have a quick think about how the CBAM price is set, so we can work out what the cost to that company is going to be. So EU ounces are sold via auctions. Auction participation is theoretically open to everybody, but actually dominated by financial intermediaries and large utilities, around 25 of them actually. And indeed, if you wanted to participate in EU allowance auctions, you can't automatically do so. So the auctions are essentially a restricted space. But CBAM certificate prices are nonetheless being set by the auctions. So in 2026, the price will be based on the quarterly average price of EU allowances sold in each quarter. And in 2027 and beyond, the CBAM certificate price will be set weekly based on the average of the auction clearing prices. And a little graph here shows a very simplistic view of how that auction price is calculated. Now, we've got a bit of a problem with the EU ETS in that the available EU allowances needs to decline to zero. Firstly, the EU has legally bound itself to reduce emissions to zero by 2050. And indeed, the current rules of the EU ETS will see the availability of EU allowances drop to zero by 2040. And here we've got a calculation of how the cap declines over the next, it shows 20 years, but over the next 15 years looking forward. And this is both the EU allowances that will be auctioned as well as EU allowances that will be given away for free. And if we look at what the price forecast, or what the prices have been and what the price forecast says they will be, we can see a pattern emerging, and not an unexpected pattern. I mean, if there are no free allowances and no auctioned allowances, then you'd expect the price to be very, very high indeed. The reality will be something less than a stupidly high price, because companies will either not operate or they will find other ways of reducing carbon. But we can see here we have the historic price up to 2025, and then we've got the predicted price out to 2034, and extrapolated all the way out to 2040. We'd expect to see some pretty high prices because of that supply restriction. Now, going back to our example, our Turkish example, I've got a graph here. If you concentrate on the grey line at the top first, the grey line are the emissions. And in this example, we've held the emissions flat. We would expect companies really to reduce their emissions, but I'll talk about that in a moment. And we've got emissions subject to CBAM in the green line. Of course, that rises over time, so we hit 100% by 2034. And when we multiply the emissions times the expected carbon price, we get the red blocks. And you can see those costs are relatively manageable in the early years and enormous in 2034. And so we can see those figures in the table and the assumptions that we've used in terms of the carbon price. Now, just taking these projections one step at a time. In the long term, there's a very high cost risk. We've got high EUA prices. And the way to manage those costs is going to be through decarbonisation. But the trouble is decarbonisation takes a long time. So in the near term, managing that CBAM financial risk is obviously very important, because as we can see in the near term, the chance of the price going higher is material. Of course, another way is to hedge exposure with EU allowances. If we take current prices and we take projected prices, if you were to buy all of your CBAM exposure or to hedge all of your CBAM exposure today, your costs would decline massively over the fullness of time. And so we've got an illustration of what that might look like Here, we're looking at around a 50% saving if all CBAM certificates are bought today at current prices. But of course, there's also the opportunity to decarbonize. And so in the end, we expect that the best way to manage the risk is to invest in projects that reduce carbon, as well as hedge as much as you can, as early as you can. The alternative is to be a price taker over time, and that will suit some companies better than others. So we have a bit of mixture there. This scenario assumes a 64% saving, doesn't necessarily include the cost of decarbonisation. So with all that knowledge about how the EU ETS works, about what's expected to happen in the EU ETS and how CBAM works, what can companies do about it? Now, in theory, EU allowances would be the obvious option for hedging against CBAM financial risk. Prices are obviously correlated because the CBAM certificate prices are based on EU allowance auctions, and EU allowance auctions are more or less correlated or more or less in line with market prices at the time of each auction. So on the face of it, EU allowances are a good hedge, and I think that's probably right on a macro basis. But in practice, there are some problems with EU allowances. We've got issues around secondary market price volatility, issues around market access, and indeed price timing misalignment, which I'll show you just quickly now. This is the EU allowance price earlier this year, and we can see it's been pretty volatile. If you look at the high and the low in the first couple of months, or February, March, we've got a variance of 25%. We've seen the price hit 81 euros. We've seen it hit 61 euros. If you get the timing of the sale of your EU allowances misaligned with when you buy your CBAM certificates, you're exposed to a pretty serious risk, a pretty serious price risk. But beyond that, if we consider the individual daily auction prices during that period, you can see they're pretty volatile, and there's the auction average prices. So getting it wrong is pretty easy to do inside a week, let alone a quarter. And so some big gaps between CBAM prices, CBAM certificate prices or expected prices, and EU allowance prices. And then because the CBAM certificate price is set for the week following any week of auctions, there's a dislocation of a week. So straight away, you can all see that there's quite a bit of slippage risk between the CBAM certificate price and an EU allowance price. What we did then is, knowing all of this, went to market and started asking, what do customers want? And it's fair to say that there aren't many people that are CBAM exposed that are also EU ETS experts. And indeed, getting the resource together for most companies is just not an option. Essentially, no one has access to the EU ETS markets already. So buying as EU allowances becomes problematic. A lot of companies are risk averse. They really just want to lock away a price and forget about the risk of a difference in price between an EU allowance and a CBAM certificate. And a load of companies wanted to be able to sell their goods today for next year. So price certainty becomes really important, and flexibility, right? If possible, there's a load of rules around CBAM certificates that make them a relatively inflexible mechanism instrument, and so of course flexibility is important. And so what we did is we came up with a product that fixed all those problems, and we call it the virtual CBAM certificate. The clue's in the name there. It's not a real CBAM certificate at this point, but it's a virtual one where a customer gets to lock in the price that they're going to pay for a CBAM certificate. And they can do that on a spot or a forward basis. Once they've locked in the price, when the customer wants to take delivery, then we source the CBAM certificate. And then the national authority delivers the CBAM certificate to the client's registry account. The objective here, of course, being to answer all those points that came up in our market research, and to make things as simple as possible for companies. And what are the features of our virtual CBAM certificate are that you get a fixed CBAM certificate cost today. So we fix the price, or the client fixes the price, and Redshaw Advisors takes the risk of the cost of the CBAM certificate. It's a sufficiently flexible mechanism that allows 2026 exposure to be covered, which you can't do because you can't buy CBAM certificates in 2026. Spot and forward trading available, depending on how big you are and your credit rating. When ready, customers can exchange one VCC for a CBAM certificate. Those certificates have no expiry date. They can be resold as needed. There's no volume restrictions. So for CBAM certificates, you can't sell back everything that you've bought, whereas with the VCC, you certainly can. Other things that we do is we help people understand the detail of these markets. I've really scratched the surface in my slides today, but trying to understand what's going to happen next is pretty difficult. We've been doing this 20 years. I spent my first 10 years running Barclays Capital's environmental markets business, and then set up Redshaw Advisors in order to help companies like you to understand what on earth is going on, and then make better decisions on the back of that knowledge. So that's my slides and presentation over. To summarize, we're hoping to help manage CBAM financial risk with confidence. But the takeaway here is that the CBAM regime is here to stay. It's presenting new financial risks to importers. I think everyone's pretty clear on that. But to manage that risk, it's got to be understood. And that's where us and Dubrink come in. Dubrink can help make sure you know what your exposure is to the CBAM certificate regime. And then we help companies understand how that translates into price risk via the EU emissions trading scheme. The virtual CBAM certificate, the VCC, is the easiest, is the most complete way to manage that CBAM certificate risk. Other risk management solutions are available, EU allowances, of course, and that's something we also specialize in because we've been working with EU industry now since our inception in 2014. So with that all said, I can turn it back to our hosts to handle some of the Q&A, and we'll see what we can do together to answer everyone's questions. Thank you for your time, everybody.
Great, thank you so much. That was very, very, was a lot of different things were covered that were also new to me. A lot of background that was missing on my part. So thank you very much for that presentation. We received quite a few questions, first of all, during the presentation, but also ahead of time. I'm just checking if there anything more, anything else came in. Yeah, we have quite a few of them. I think we just go through them and we'll see if that makes more sense for you to answer or for us to answer potentially, or literally because there is no information to be provided, we might not be able to answer all of them. So the first question that was asked ahead of time, and I think this is more an EU Parliament decision, but I would love to hear what your thoughts are on the topic. What will define competitiveness under the CBAM regime? Do you have any idea? Is it no more imports, or is it only net zero imports? Any ideas on the topic?
Yes, I think the simple answer to that is carbon footprint. If you're an efficient producer, you will be more competitive. The trick is working out where the marginal producer is, because that will be setting the price for whatever product in Europe. And if you're below that, you're going to be making more money out of CBAM. And if you're above that, that's going to start to hit profits. So competitiveness, in my view, has got to be defined by carbon intensity of production.
All right. Another question that came in via the chat was if you will share this presentation after the webinar.
Certainly, yes, we'd be very happy to do so.
Okay, perfect. Then we have a question about guarantees that have been, if guarantees are asked to pay CBAM certificates. To my understanding, it's not so much about the CBAM certificates, it's potentially about the authorized declarant status, where you request you expect a certain amount of CBAM imports to come in under your name, and then you may have to provide guarantees, but the exact threshold for that is ambiguous, to my understanding.
Yeah, I mean, I'm not clear on this one. And sorry, just on the previous one on the slides. Yeah, get in touch and we'll get a copy to. You've seen our contact details on the previous slide, so just please give us a shout, and we'll be very glad to supply the slides. The guarantee part of things. So the omnibus changes to the CBAM reduced the requirement to have CBAM certificates in advance, if you like, and they reduced it in two different ways. One, it reduced the obligation to 50% from, I think, 80%, and it also in 2026 reduced the obligation to 0, because you can't even buy the things. People have got the price risk, but they don't get to buy the CBAM certificates until 2027. So the guarantee requirements have been somewhat reduced.
All right, then will CBAM come? I mean, I think we have heard that throughout the presentation. The official website on CBAM by the EU has been updated in the past week to actually reflect an very explicit statement that it will, in fact, start January 1st. So I think we have the answer to that.
I think that's probably right. I mean, the EU went out of its way to say that they didn't back down on the CBAM, but they would look at ways to ease implementation. And maybe that's where some of this rumored change is coming from. Easing the implementation, I think, is going to be welcomed by everybody. But if there's one thing that Trump has allowed the rest of the world to do now, is to put tariffs on things. And so one could argue that putting CBAM in now is easier than it was before Trump.
Another question via the chat is, how did you define the estimate benchmark of 1.97 that was in your presentation a few slides back?
Yes. So this is where having Dan on the call would be really helpful, because he helps write these slides for us. But there is a footnote on that slide, and it says it comes from. I'm going to have a quick.
I think it's a JRC report, if I remember correctly.
Okay, thank you. There we go. Came from the JRC report.
Okay. And then specifically about hedging, there's a question: how can you hedge in 2026 if CBAM certificates are not available for purchase until August 2027? I know you covered this, but maybe we can just reiterate on that a little bit more to really drive the point home.
Yeah, that's right. So, I mean, well, the hedging that we offer is to sell you that CBAM certificate that would be in a virtual form that we would convert into a real CBAM certificate when we get to 2027, when they're available. How we do that, I mean, we've been working in these carbon markets for more than 20 years. And so we deploy some risk management strategies to make sure that we as a company are in a position to underwrite that transaction. The way it works in 2026 is different from 2027 in that 2026 is subdivided into quarters, so that makes it a little bit more complicated, but simpler in some other ways. And then of course we go weekly in 2027, where it becomes a little bit more straightforward, and CBAM certificates are available. What's going to be interesting is to understand the exact rules around use of CBAM certificates. So for example, if a 2026 Q1 certificate is valid for 2 years for CBAM compliance, what's to stop everybody buying assuming Q1 26 is a lot cheaper than perhaps when we get to 2027. It also stop people buying loads and loads of those and using those as a hedge. We just don't know. The rules are slowly coming through. Once we know those in full, we can give further advice on how to optimize within those rules. But in order to lock in the price today, we work with the EU allowance market, of course. So the price of a virtual CBAM certificate looks very much like the current EU allowance market price.
All right. That's answered. Yeah, and then the question, I think you repeated that by showing the cost formula, how the benchmarks play into the pricing formula, and I guess this just determines the free allowance under CBAM, more or less.
Essentially, that's right. Yeah, I mean, we'll get. We really need that clarity.
Yeah,
it's pretty remiss of the European Commission to not be providing that in a timely manner, because companies have real financial risk starting now, actually, and they're trying to do deals for next year. We'll get it, I guess, as soon as they possibly can.
We received a question also in the chat, which is, what happens if the embedded emissions provided by the supplier is lower than the product between the estimated benchmark? Basically, the emissions of the supply chain are lower than the benchmark value, and you would have a negative answer. But we think you will not pay anything. You'll probably not get money back.
Well, I think that's exactly right. So it'll cost you nothing to import, but you don't get money back for being more green from the European Commission. But the marginal producer of a ton of steel isn't a zero carbon producer. What I mean by that is the demand in Europe is going to require all the green steel that's out there, plus some more. And so the compensation will come with a higher steel price because all of your competitors that are dirtier, that are producing more emissions, will be charging for the carbon cost. So that's where you get the money back. The bonus.
And then third-party emissions verification. Can you shed a little light on that?
Right. I was hoping you'd talk about that.
No, I can do it as well. Yeah. So the way we understand it is that sorry, this was very unexpected. Basically, verifiers in Europe that are currently doing ETS verification would be appointed to do, let's say, CBAM verification, except that they would then have to appoint someone in third countries to go and do the physical inspections of invoices and chimneys to check if the emissions, that have been reported are actually in line with the data that was used to actually calculate that. I think this is the basic fundamental that will define how the verification works. But again, there should be a draft regulation coming up on this soon, but then maybe that plays also into one of the rumors that might make sense to address at the moment. And I think that may be also the next question. No, it's not, but one second. Yeah, it's just the question right after that. So how realistic do you think this new rumor for default values for all countries without an absolute cap and trade system is? Maybe you can explain a little bit what it means, and then we can answer the question before that as well.
I mean, how realistic is the rumor? I mean, who knows, right?
That's of course, we have no absolute certainty on the rumor itself, but maybe we can explain a little bit what the actual.
Yes, that's right. Okay, so the rumor is that we get default values for any country that doesn't have a cap and trade regime that is the equivalent of the EU ETS. So essentially, at the moment, that's pretty much no one. There are cap and trade systems in a number of countries, but they don't necessarily adopt a net zero target of 2050. Perhaps South Korea might work.
UK?
UK for sure. Apologies. Yes, I'm still pre-Brexit in my mind. If there's no proper, shall we say, cap and trade regime in existence in the country where the product is coming from, then the individual producer doesn't get the chance to verify its emissions level. It is provided a default value by the European Commission on which it will be measured. And what that means is that green steel producer that we talked about just now doesn't get the advantage of green steel. They would have to pay for the carbon cost at the default level for its country. So that's not good news. The flip side, though, is it makes the system much, much simpler. You don't have to then do the verification that we've also just talked about. And it also means that companies within countries don't bend the rules, or they don't have the incentive to bend the rules. A rule-bending thing could be to take your most efficient production and export it and leave the dirty stuff at home, which means there's no impact on carbon footprint, no beneficial impact on carbon footprints. So it's one of the, it's a simplification that could be better for the environment and better for administrative issues. But it's not great if you're the highly efficient producer, that's for sure. Will that come in? We talked about the US. That might make some sense because we're making the CBAM system simpler. It seems like a pragmatic and sensible solution because there'd be relatively few people that green producers that would or greener producers that would lose out. Of course, the devil's in the detail. What are the default values going to be? How? I mean, there's even talk of them being penal, as in much higher than may even be true. We'll find out, right? That's all we can really say at this point. Probability of something that simplifies the system in this way, I'd say that's, I think it's more likely than not, right? Especially if they're
actually considering the timeline as well, because we're only 3 months away from.
Well, right, to get things over the line, that's right. And also these consultations, one of the consultations is how to simplify the system. So let's wait and see. But of course, between us and Dubrink, if we find any news, it'll be sent out as soon as we get it.
Yes. And then the question we did not address is the one, and we see a similar one in the chat, which is basically, is there, are people buying up?
Yeah, right. So, I mean, if you don't know what you need to buy, that's a real problem, funnily enough. And if you think this, if these rumors are true and there's going to be a penal default rate applied to products, buying more rather than less is an entirely sensible risk management approach. Bearing in mind, the amount you need to buy in 2026 is a tiny part of what you'll need to buy in 2034. So even if you're buying for 2026 and you don't need it and don't use it, you can bank it. Especially if you're using the VCC, you can bank it indefinitely. There's no 2-year time restriction on it. And also, I suppose the reason, so you might be a bit anxious about your exposure, perhaps not in 2026, but in 2030. It depends on what kind of company you are, how far ahead you're thinking. But owning more CBAM certificates or virtual CBAM certificates has got to be better than owning less, given what's going to happen in the future. And one of those things that's going to happen in the future is the supply of EU allowances goes to zero, right? That's programmed into the law as things stand. And that means prices inevitably must rise. So if you're a believer that prices must rise and you're anxious about your exposure, increasing exposure to CBAM as the years go by, buying more than you need, and of course the default values issue as well. Those three things combined mean that buying more than you need for Q1 2026 would appear to be an entirely sensible thing to do.
And then there is a question in the chat, which is about a potential market correction, because a lot of companies are currently buying EUAs potentially to hedge CBAM, and they're going to sell that off the moment they can actually purchase CBAM certificates. And if you foresee any large, I mean, you're obviously not in a position to predict prices, but you can obviously maybe comment on this phenomenon.
Yeah, so buying EU allowances gets you a sort of a broad hedge. If the price is 70 euros today and it's going to be 120 euros in 3 years' time, right, that 50 euros gap, right, buying EUA is a perfectly reasonable way to bridge that gap, right, if you're nervous about that price going up. The problem with EU allowances is that there's no mechanism by which you can convert an EU allowance into a CBAM certificate. And you are going to almost always lose money trying to do so. So it's about it's not just about bridging the gap to 50 euros. It's also the shorter term amounts of money that inevitably will be lost by smaller participants in this regime and less sophisticated participants and those without market access and so on. So what we've set out to do is just to take all that noise away. But the virtual CBAM certificate itself also bridges the 50 euro gap. Right? So EU allowances are just fine. The VCC just gives you more certainty.
Makes sense. Okay. Then we have the question, how far do you think the benchmarks will deviate from the current ETS benchmarks?
Well, we're talking about the EU benchmark as opposed to the, yes, of course. So they will, the benchmarks will come down. They probably won't come down a huge amount. The way benchmarks are set are the top 10% of any given sector, as long as there are a sufficient number of producers to produce a meaningful average. And in previous, so we went from phase 2 to phase 3, phase 3 to phase 4, where we had benchmarks, and the cut wasn't enormous, and they have some default values within that also. There's a minimum amount that the EU expects industry to reduce its emissions by, but it depends on what sector you're in for what that minimum is. There's also a maximum, so it's controlled. It won't be enormous, would be my expectation right now.
All right. We have, yeah, do we see a large volume of companies burying their heads in the sand, hoping CBAM will disappear?
And I think it's fair to say there's a mixture. I would argue that the biggest companies with the most resources are taking this very, very seriously, and that the smaller ones are engaging less at this stage. We would encourage everybody to take it seriously. The benefit of our organizations is that we can give really good advice and support to everybody.
Yeah. On the question about, let's say the rumor is in fact true and they would use default values, how can individual suppliers shield against such a, like basically their individual decarbonization efforts would not be taken into account because it would be the country's regional average or whatever. Any ideas how companies like that could potentially protect themselves from that exposure?
Yeah, I mean, I think economically speaking, they're already producing, presumably making a profit doing so. All CBAM is going to do is put prices up in Europe. Therefore, arguably, the protection comes from the fact that European consumers are the ones actually paying the higher cost of all of this stuff. Yeah. Okay,
and then we have a question about the CBAM certificates. So CBAM certificates cannot be traded. Reason, if I understand correctly, to avoid speculation. But there is there not a risk that companies buy VCCs or similar in excess, since they don't know how big the exposure will be, and by that way create a bubble on the EU ETS?
I think the answer is no. There won't be a bubble caused by people hedging CBAM. It's always a possibility, of course, but right now, speculators in the market for both the UK ETS and the EU ETS have got positions, summing to about 50 million tons. And at other times they've got positions that sum to nothing. Now we do get volatility in the EU ETS price as a consequence of that. But if we think about how much companies are realistically likely to buy to cover CBAM exposure for next year and maybe future years, relatively few industrials tend to look out past 1 year in hedging terms. But people, that's our experience anyway in our EU ETS activities. So the impact of people buying EUAs now to hedge against future exposure, the impact on the market overall, I'd expect to be undetectable. Possibly, an influence of a euro or two at the extreme. You've got to remember that the EUAs that are bought now as a hedge get sold back later. So if you think of it in pure supply and demand terms over the fullness of time, actually that pre-hedging has no impact at all.
And because they're not used against the EU ETS.
That's right. Eventually they get sold back to the market.
Yeah. Okay, that makes sense. And then do you expect UK CBAM to be more expensive due to the inclusion of indirect emissions?
So UK CBAM is designed very differently to the EU CBAM. It takes into account the free allocation that companies get, as well as any other subsidies that they get. And then the UK puts together a default value again. But the default value in this case is on both on the product. So UK allowances are cheaper than EU allowances, but the way UK CBAM works is not the same relationship between a UK allowance and the CBAM price. It's actually the cost to the individual sector. That's a pretty good question. I've not actually thought about it in those terms before. I would have thought the EU would be the more expensive on balance. Perhaps worth having a think about offline.
It's also the EU ETS price just being significantly higher than the UK ETS price at the moment.
Yeah, it has. I mean, that's another interesting fact in relation to ETSs is that the UK used to be part of the EU ETS, of course, and then Brexit happened and we had two markets. But all the talk right now is that those two markets linking back together again, so the price will be equal. In order to link back together, it seems that the UK would have to adopt the EU CBAM. So that may well be where we're headed. There's a lot of, as soon as you take two things back together, but they've changed the rules in one, things get pretty complicated. We haven't got any information on that, but there is a task force set up to negotiate that linkage by the EU, and the UK is obviously keen. So that will all happen, but exactly what form it takes, we're not sure.
So we have a few more questions. I know we're already 7 minutes past the original time we have set out. Do you have a little bit more time, because we have almost every participant still in the webinar?
Oh, yes, of course. As long as people want to know stuff, we're happy to help.
All right, great. So one question is, do I understand it correctly that we have to pay the obligation to pay CBAM taxes from 2026, but the certificates will not be available until February 2027? So the answer is yes, I believe.
Well, no. So the obligation is created, but the money out the door is not required until 2027. The issue is that you don't, if you're selling your product, you don't know what price you're going to pay for those CBAM certificates until later, and that could, with the volatility we've seen in the ETS, wipe out all the profit and more. Hence the emphasis that we put on managing that risk.
Okay, and well, we talked about UK and EU CBAM deadlines quite a bit, so I think we can skip this question. And well, UK CBAM deadlines, there is very little known at the moment. They're in draft and they're asking for feedback, but that's it. And I think that's it from the questions that were asked ahead of time. Then we still have a few of them in the chat. Just a second. Popular. Okay, so how can you hedge today when you don't know what quantities CBAM goods you will import in the future?
Arguably, if you think the price of CBAM certificates is going higher because the EU allowance price is going higher, then buying something would be a good idea. If you're worried that you won't be able to export should the price go above a certain level, having some hedging in place would be entirely sensible risk management. If you don't know how much you're going to import, arguably you haven't sold your goods yet, right? If you haven't sold the goods yet, this is my presumption, there may be differences here, but if you haven't sold the goods yet, you haven't set the price yet. If you haven't set the price, if the carbon price goes up, you ought to be able to recover the higher carbon price in the sale price, and at that point, lock everything down would seem sensible. Of course, the individual circumstances will vary, and we're happy to talk about how that risk might be managed should the need be there.
All right. Another question that came in is that according to Article 20, this is about CBAM regulation, I suppose, it says that, of course, only declarants are able to purchase CBAM certificates. Now, that's not the case for VCCs, if I remember correctly. Maybe you can explain a little bit about that.
So our objective is to source those CBAM certificates. The rules aren't set yet. If we can't, then we've thought about that, and we've got a mechanism by which we can make sure the CBAM certificates get to where they need to go.
Okay, and sorry, a lot of new questions come in, so I'm also trying to sort by the most upvoted ones. This one we answered. And why has the EU been so late in informing importers about the actual CBAM framework? And this was asked anonymously, so a little skepticism, I suppose. And then with only 3 months left before it fully applies, at least half of the industry still does not know what to do or how to approach/estimate their costs. What's the reason for this delay?
Yeah, I can't explain exactly why there's a delay, but I can say this happens all the time, and it happens all the time in a lot of legislation. But let's think about the ETSs for a moment. So the EU ETS was born on the 1st of January 2005, and yet there were no allowances in circulation for anything until as late as 2006. Now, I'm exaggerating slightly because there were some allowances in circulation in around mid-2005, and a whole load more got issued in December or towards the end of 2005. But some countries didn't allocate their allowances till 2006, causing all sorts of consternation and issues. And the UK emissions trading scheme started on the 1st of January 2021, and yet there wasn't a single allowance available to help people hedge the risks that they were taking in January, February, March, April. They didn't do any auctions until May 2021. So unfortunately, it would appear to be the nature of the beast. Why they're delaying is purely because it's complicated and everything takes time, especially new legislation.
Yep, and if you could remind us on the CBAM phase-in percentage, what does the 2.5% in 2026 correspond to?
It corresponds to the EU benchmark, but what is often overlooked is if you're at, let's keep it simple, if you're at €2 per ton and the EU benchmark is €1, if you're 2 tons of CO2 per ton of product and Europe is 1 ton of CO2 per ton of product, then you need to supply, in CBAM certificate terms, 1 CBAM certificate for every ton. The difference between 2 and 1 first, and then 2.5% on top of that. 2.5% of the EU's 1 ton.
Okay, and then I think we have, it's a question about the VCCs, and is it 100% sure that we can change the actually available certificates, I'm assuming that's the VCC, into CBAM certificates?
Yes.
That was a very immediate answer and quite clear. Okay, we have quite a few more, but we already answered some of them. Okay, and then some importers, like those in the fertilizer sector, often have very small teams, sometimes only 5 employees running the whole company. How are such small-sized companies expected to approach CBAM when many of them are not familiar with CO2 accounting or sustainability factors?
Really, the bottom line there is to source a trusted and professional advisor to support.
We might be able to help you with that. It was an anonymous question, so I can't see if it's someone from our side already. But please get in touch. I think I have even a slide for that. And that also kind of brings us towards the end, to be honest, because we have a couple of duplicate questions. I think, maybe.
Yes. May I bring up one small point? Because I quite often hear also from clients of Dubrink a question which I also see here is like, how can you hedge today when you do not know what quantity CBAM goods you will import in the future? And Louis, correct me if I'm wrong, but eventually the cost of CBAM is the amount, indeed, times the price of the certificate. And even if you know the amount, the certificate price, you will actually never know in the future. And I know some cement companies, and they hedged like many, many years ago, a lot of volumes just to make sure that they know what the price is going to be in the future. So to me, it's sometimes, I understand that people want to know their volumes, but what is more important is that you make sure you have enough of these things on the shelf that you can stabilize your price. Or am I wrong? That's where it's about, right?
I think that's entirely sensible. So, I mean, clearly, the cost of EU allowances, the price of EU allowances can go down as well as up. And if you get into the detail, you start to feel much more comfortable with the idea that they're more likely to go up than to go down. Right? So that's something that we can explain to companies, and we do that on a regular basis, just trying to help them make plans for the future. Going back to your analogy or your example there, the cement companies. So I know of a steel company, right, who bought back in 2017, I think it was, enough carbon to last them till 2025. Right, that was in Europe, and that's because it was foreseeable that the price was going to rise. And in that instance, the price went from single figures through to so by 2025, that's now, right? So we've gone via 102 down at 76 at the moment. So they got it right. But then the evidence was so compelling that the price was going to rise that became an obvious thing to do to them, because they did the thinking about it, or they got the people to come up with them, help them understand that market. But having another prime example is RWE, right? So they went public, they bought enough carbon from the market to neutralize the expected impact on their coal-fired generation. So what it meant was, if they couldn't run their coal-fired power station, they would sell the excess carbon credits and make the money that way. The reason they couldn't run the coal-fired power station would be because the carbon price is very high. And if the price wasn't very high, they'd run the coal-fired power station. So they were hedged. They had more than they needed, but you got to define need, right? So RWE's need today is not to buy millions of tons of EU allowances, but its need tomorrow and next year and the year after potentially is. So therefore, the time horizon of your need is a relevant consideration. Everybody is short over time. The question is, at what point does that make you nervous?
And just to make it clear, if people buy the VCCs, they can always return it, right? It's not that suddenly it disappears in thin air. I think that's important, that even if they buy it, let's say, for 70 euros and it goes to 90, then it goes to 60, and then they actually want it back, they can still sell it for 60, right?
Yes, correct.
All right. Anything else from your side, Marcel? Because there are a few questions which I will answer in a single, like 1 or 2 sentences, and then I think I would hand over the mic one last time to you, Louis, and we can finish up this webinar. So CBAM certificates, validity, it's 2 years, to my understanding. Is that correct? That there's an expiry date on CBAM.
Yes.
Right?
Now, strictly speaking, it is what is it? It's I think it's how many? It's 34 months or something from the date that you buy it.
It's definitely not 1 year. That was the specific question that was asked. I think it is
more
more
than
than a year.
the day you buy it. Sorry, it's 34 months from the year that you buy it. That's right. And so if you bought it on the 1st of January in 2025, that they would last something less than 2 years, and if you bought it on the 31st of December, they would last more than 2 years, something like that. I forget the exact rule. We've got it written down somewhere because I looked at it just the other day. But essentially, right, you buy a CBAM certificate, and if you haven't used it within, on average, 2 years, it's gone.
All right. And then, yeah, the specific one of the last questions to address is what is the support that Redshaw can give to companies specifically?
Oh, right. So
way to end.
Yes, no, it is, and maybe that's my final word. So we specialize in helping companies to understand carbon markets, environmental markets in general. Carbon markets is a big focus for us. I've been doing this for 21 years, and so when I was working at Barclays, we had a great service. We had research, we had trading, we had sales, professional sales folk, and they would service the very largest companies. There's something like 4,500 companies covered by the EU ETS, and perhaps more now covered by CBAM. And what we sought to do was provide that sort of high quality investment bank service to everybody, make it available to everybody. And in fact, we believe that we have improved upon that service. We give a better service than the investment banks. What we will do is we will consider the exposure of individual companies and what they're trying to achieve, and help them make decisions on what to do about it, as well as provide the information and the data that companies need to be able to present to their boards what investments they would like to make, and so on. So our job is very much hand-holding companies through this environmental markets legislation, and then after we've informed them on what's going on and advised on what they can do, we can help companies with the procurement side of things too. They're pretty complex markets, like any market, right? The reasons the price go up and down are complicated. The rules keep changing. Keeping ahead of those rule changes and the impacts those rule changes will have on financial risks, really important. So that's what we do. We make sure that companies go in armed and ready to take on those risks.
All right. Thank you very much for both the presentation and the Q&A. I learned quite a bit, so I thank you very much. Everyone that joined us today, thank you also for joining. I wish you a wonderful remainder of the day. If you want to get in touch with us or with Redshaw, we will send you a follow-up email just with all the points of contact for the specific services and things we have discussed today. Wonderful.
Well, thanks for the opportunity. Nice to be able to speak to you all, and good luck with CBAM.
Bye-bye.